Okay, let me share my screen. This is not going to be a super professional video. I don't think it's necessary. But I do want to get the information to people who are interested at their own convenience. Hmm, Okay. Okay, so hopefully you can see 10 critical things everyone should know before they buy their home. And basically what this video is for is to be able to have real estate agents be able to send this to their clients who are first-time home buyers, get some information for them about buying a home. And then any questions that you have, you can reach out to me anytime. So let me show you my information that you can write down, my application website. You can go take a look at that. I've got lots of CE classes for real estate agents. We did have on there, I don't know if they've deleted it yet, classes for first-time home buyers, but we didn't have a lot of people being able to come. There's not like one time that fits everybody's schedule. And so that's the idea here, is to be able to have a video where they can watch at their convenience, listen to it while they're driving to work, which I love to do with podcasts and informational videos. Here's my phone number, my email. Go ahead and write those down. Or you can just come back to it, obviously. And then any questions that you have, that's the only thing about doing the class like this that makes it a little bit more difficult, is that if you have questions, you can't really ask them in a situation like this, but I'm happy to answer phone calls or emails anytime. So please feel free to ask any questions that I might not answer in this class. It will also help me to kind of see, if I need to make another one with more information. So, okay, 10 critical things. This really should only take about 20 minutes, especially since we're not going to have any informational questions that people are going to ask. But let's go through these 10 things quickly, and then we'll go back and dive in a little bit more deeply. Owning a home long-term is going to crush renting. And I'll show you an actual example of that in just a minute. So short-term, definitely it's going to be more expensive than renting. And that's why a lot of people don't do it. But if they can see the benefits long-term, they can realize what a great investment it is. And people who own houses on average are have more wealth than people who don't, right? Obviously, they've got equity in their home that they can tap into if they need to. And so over the long run, you're definitely going to crush renting. Basically, when you're renting, you're making somebody else's payment, making them money and equity. And so as soon as you can and it's feasible, you want to move into the home ownership side of things. The longer you wait, the more it costs you. Get in the game as soon as you're able. If you could, hindsight's always 2020. If you look back to people even in the 2006 time, if they bought a house, that's when I bought my house. And, then that they kind of had the crash in 2008 and then it came back up. So, if you can wait out those crashes, which I don't think that that's coming up. I don't think this is a bubble. There's just too much demand. Kind of put a damper on things when the rates went up. But if you can qualify at the higher rate, it's definitely still a good time to buy. One of the things you definitely don't want to do is buy low and sell high, right? And so, buy high and sell low. So you don't want to sell during those crashes if you can avoid it, because that's when you're going to lose money. Okay, if you plan on selling a home in the next 2 years, don't buy, because it's not gonna give you the benefits. Really, the benefits of owning a home or keeping it long term, unless you happen to trick the market right. There were some people in 2020 that made a lot of money because homes went up really a significant amount of money, in some cases $100,000 in 1 year. You don't need 20% to buy. So we're going to talk a little bit about what you do need as a down payment, closing costs, etc. Get pre-approved as soon as possible. Today I did a pre-approval for someone and we ran their credit and it was way lower than they thought. So you're going to want to get a pre-approval done, run your credit, never pay for a pre-approval. There shouldn't be any fees for a pre-approval. But a few months before you're ready to buy, get in and find out how your credit's looking. There may be something you didn't know about. And then you have a little bit of time to get that taken care of before you're ready to buy. Use a good realtor. I know a lot of them. If you don't have one, let me know, but using a good realtor is going to make a huge difference. A good realtor is going to ask you to get pre-approved before they start showing you homes, because they understand how important it is to be pre-approved so that you're not looking at things you can't afford. Understand the 3 C's of mortgage. We're going to talk a little bit about those: credit, capacity, and collateral, right? So your credit is super important. You'll hear that a lot. We'll talk a little bit about that. Collateral is the house, of course, when you're buying a home. And then capacity, your ability to pay back this loan that's a 30-year mortgage. Understand the buying process, what happens after you go under contract, and make sure to attend my trainings is what it says, but we're going to skip that. So, okay, let's talk a little bit about what the pre-approval process is. And basically, just really quickly, we'll go into it a little bit deeper. But before we talk about the cost of waiting, I just want you to know your agent will say, your realtor will say, go get pre-approved. And here's some names of good loan officers. Sometimes they'll give you more than one. Sometimes they'll give you their favorite. But you know a good loan officer now. You have my information. Reach out to me. I will talk to you for about 15 minutes, kind of about where you want to buy. There's different loan programs for different areas. There's different loan restrictions for different areas. So loan limits for different areas. So kind of ask you, where are you looking to buy? And then we'll talk a little bit about income, your job, and those kind of things, so I can get a basic idea of, does this make sense for you to move forward now? Are you going to be able to buy something? Typically, you need to have a 2-year work history. We'll go into that a little bit deeper later. So we're going to chat for a minute and just find out, how are you doing? How much money do you have to put down? Those are going to help me figure out what are going to be the best programs for you. And then I'll have you fill out an application. It takes 10 or 15 minutes. You can call me with questions as you're filling it out. Get your application, send you a secure link to upload documents. Once I get your documents, it takes about 24 hours. And then we can, sorry, my phone's ringing. And then we can go ahead and get you pre-approved. We'll pull credit. Always with a pre-approval, we're going to pull credit. And so that makes a big difference, because without pulling credit, you really can't give an adequate pre-approval. And then we'll run your file through what's called a digital underwriting system. It gives me approve eligible or not. And basically we sell direct to Fannie and Freddie. So if we get an approve eligible through that digital underwriting system, that means we can prove what's on your file, then we're good to go and we can sell directly to Fannie, and that's a good loan. Okay, let's talk about the cost of waiting. That's a big deal right now with interest rates so high. People are like, I'm going to wait till interest rates come down. And I get why you would do that. Some people have to wait until interest rates come down. They don't have a choice. They can't qualify for any high enough to be able to get into anything. And so they have to wait for interest rates to come down. The other alternative is to get a higher paying job, and that's not quite as easy, right? But those are your 2 options for trying to qualify for more: is more income, or waiting for the interest rates to come down. The other thing would be debt. So if you have, just for example, I see a lot of people who come in with big car payments. Cars are easier to qualify for than mortgages. And so if you're trying to decide between getting a new car and getting a mortgage, I would always recommend looking at getting a mortgage before you buy that car, because you can go and get a car mortgage or a car loan easier after you have your house than the other way around. For example, every $50 of debt you have will cost you about $10,000 in buying power. So if you have a $1,000 car payment, it's going to cost you $200,000 in buying power. You think about your debt that way, it's pretty sobering. So $500,000 car payment, which is maybe more typical, going to cost you about $100,000 in buying power when you go in to buy your house. So definitely think about, waiting to buy that nice car until after you get into your house. Okay, let's look at this example, real example. 2000, year 2000, he buys a home. And, the numbers aren't going to necessarily match up to what we're doing right now, but the idea and the value of looking at the cost of waiting is going to be helpful. Okay, so if we have a $150,000 house that you buy in 2000, and we've got a loan amount, 142.5. They put just, the normal 3 to 5% down. And the monthly payment is $764.97. Okay, we've got taxes and insurance. Our total payment's $864.97. We look on the right and it shows a monthly rent payment of $650. Now, again, these are lower numbers than we're seeing now, but the idea is the same. To buy, your payment is going to be more than the current rent. That's always how it's going to be. So again, in the short term, it doesn't look as good to buy a home as it does in the long term. Now let's go down a little bit. Every time you make a monthly payment, part of it goes to principal and interest. The principal part is paying down your loan amount. So you can kind of look at this and see, like, the taxes and insurance are going to go up because taxes and insurance go up. They can on a yearly basis. Our property taxes go up, but your principal and interest payment stays the same for the life of the loan. Now, rents go up every year, right? They can raise your rent 3%, whatever the going rate is, right? Every time you sign a new lease, they can raise your rent, and you'll see that happen. So that in 10 years, well, this one's 13 years, the person who bought the house 13 years later has $355,000 in equity, whereas the person who's renting is now paying triple what they were paying in rent. Okay, so the cost of waiting is real. And again, if you can't qualify for enough right now with that interest payment, with the higher interest, that makes it really hard to jump in. But as soon as you can qualify, jump in, and finding out how much you qualify is going to help you make that decision of when it's time to jump in. Yeah, you can, obviously being able to save is important too. And we'll talk a little bit about that. When you're thinking about buying a house, you need to kind of figure out how much can I afford to pay in a payment, right? Not how much we want to, but how much can I comfortably afford? And right now with the interest rates higher, people are getting into houses and maybe you're kind of crunching their numbers. If they've got, a lot of people have two incomes, but you want to kind of think about what you can comfortably afford, but don't negate the fact that it costs you to wait. Okay, so jumping in as soon as possible is going to be beneficial to you, but you need to jump in with the knowledge and understanding of what you're doing. Okay, so I like to show this, when's the right time to buy and talk about that. I joke that the best time to buy a house is today. The only better time was yesterday. Okay, so if we look back, everybody always wishes 10 years ago that if you look back 10 years ago to housing prices, everybody'd want to buy as many as they could right now. And that's always how it is. But 10 years ago, people were like, oh, houses are so expensive. I don't know if I can afford it. So you're always kind of feeling like that. And so we need to think about that. You can see here that dip in around 2008. 2008, it started to kind of go down and dipped, and climax the dip was the lowest around 2011. And then we've gone up since then. If you take your cursor and you follow it a straight line up, we're right about where we should be. We just had that dip and then we went up really fast. So I don't see, this little down here between 2021 and 2022 is caused by the rates going up, right? People kind of cooled and were like, okay, wait, can we afford it? Now people are kind of feeling like rates, this is kind of a norm, right? The feds, keep raising the federal rate. Inflation's a problem, which is more of an effect on mortgage rates. So I always tell people, date the rate, marry the house, divorce the landlord. Okay. The biggest thing your biggest goal needs to be to divorce that landlord and stop making somebody else's payment and making them money, and make yourself money. Okay. So we can look at kind of home prices, home sales, median home sales. Now that's not the average. That's just that out of 100 homes, 50 were higher, 50 were lower. Okay. So you can see that fourth quarter 2022 prices did come down a little bit. And as soon as interest rates go down, you're going to see a frenzy and prices are going to go up a little, again. So, getting in the market now, I talked to one guy who really understood this, and he was like, okay, I want to buy now, even though the interest rates are higher, because as soon as interest rates come down, then I'm going to end up paying more for the house, the same house. So I'll pay a little bit more in interest now, but then I'll refinance when rates come down and I'll already have the house that I want instead of having to go out and compete with offers to get that house that I want. Okay, let's talk a little bit about down payments. There's a lot of different ways you can get your down payment right. Obviously, saving in your savings is one. 401k loans, you can pay those back without interest. You can get a gift from parents. I see that a lot jumping into the market. Some parents are giving gifts of down payment or closing costs to help their kids get into these houses. But basically on a conventional loan, your minimum down payment is going to be 3% of the purchase price. Okay, if you've never owned a home before, or if you're a first-time home buyer again, meaning that you haven't owned a home in the last 3 years. So you can be a first-time home buyer every 3 years, as long as you're not on title and don't own a home. Okay, so 3 or 4 or 5% down is going to be a conventional loan. FHA is 3.5% down. And recently FHA loans have become more competitive with conventional. Their rates are always lower. In the past, their mortgage insurance was always quite a bit higher. And so now they've lowered their mortgage insurance rate, so they're a little more competitive. So we're going to look at which of those programs is best for you. Typically, if your credit score is under 700, an FHA loan is going to be better, give you a better rate, and they're more lenient on some of the lates and problems on credit. Zero down is Utah Housing, is an FHA loan program that has a second mortgage that pays for your down payment and closing costs. So you'll have a second mortgage payment. It's a little bit more expensive, but if you think about the cost of waiting and how long it might take you to save the money for the down payment, you may be fighting an uphill battle and saving faster than the market is changing. So that's something we can look at. VA is also a zero down. VA is I consider one of the best programs if you qualify for it, but of course you have to be a veteran, and the only people on that loan have to either be veterans or married to a veteran spouse. USDA is another one that's a zero down. You still have to pay closing costs, the same as VA. You pay closing costs, but you don't have to put any money down for the down payment. That's something that sometimes people don't understand when they talk about zero down. You still will have closing costs. Utah Housing is the only one that has the second mortgage can cover most of the closing costs. Okay, so USDA is a rural loan in rural areas. Saratoga Springs is actually still rural, funny enough. That's hard to say. But south of Spanish Fork, north of Ogden, except for Logan, west of the Jordan River. So there's still some places nowhere in Salt Lake County is considered rural, but that can be another option. And I always look at it, but right now there's an income limit for some of these. Same with Utah Housing, not for VA, but Utah Housing and USDA. So a lot of people who make enough, if they make too much, then they don't qualify for it. And with USDA, they have a little bit lower debt to income ratios, meaning how much debt do you have versus your income. And so sometimes people, if they fit in the lower debt to income ratios, they make too much, and vice versa. So I'm having a hard time right now qualifying anybody for USDA, but we're always going to look at all the different loan amounts and what they mean for you. Okay. Principal residence versus investment, just so you kind of have an idea. I know this is a first-time homebuyer class, but just so you have that in your mind, if you're going to move into the house, it's principal residence. If you are going to rent it out, it's an investment property. And those have different rules. So if you're going to rent it out and not live in it, then you're going to need to come in with about 25% down. So that's the difference there. And the interest rates are higher. A second home is kind of an in-between. But their rates are a little bit higher. You can come into a second home with 10% down, but that's not something you can rent out long term. That's a home that you're going to go visit at least 2 weeks out of the year. Okay. But right now we're talking about primary residence, first-time home buyers. Okay, so the home buying process, just quickly an overview, you are going to get pre-approved first, which we talked a little bit about that. Give your income documents, your W-2s, if you're self-employed, your tax returns, and then we're going to look at your credit and figure out, okay, and your debt, and figure out how much do you qualify for, right? Because you don't want to go out and look for homes if you don't even know what you qualify for. That makes it hard, right? You're looking at homes you can't qualify for or whatever. You're going to meet with your agent. And they're going to be able to show you homes in your price range, get you set up on their website so that you can look at homes yourself. And you can start looking at homes online, kind of see what's out there. Is this going to be the price range where I'm going to be happy? And kind of start figuring out. Then you'll go and look at homes, look at homes in your price range, right? You say, okay, I see this home. I think it looks nice. I'm going to go look at it. And you'll find that sometimes pictures are deceiving. And so you do want to go and look at the physical home. Then you're going to put an offer in on one that you like and hopefully get that accepted. Sometimes we see people, houses with multiple offers, and that makes it a little bit hard. But you're going to hopefully get accepted, and then you're going to put your earnest money down. And typically earnest money is about 5% of the purchase price, but it can be negotiated. You have 4 days to give it to your agent once you go under contract, and they have 4 days to deposit it. And so you're going to want that earnest money in the bank, and that's held there. Sellers you never want to give your earnest money directly to the sellers. Either the title company will hold it or the real estate agent will hold it for you. And that sits there basically in good faith saying, I am pre-approved and I do want this house. And if I don't comply, then you get to keep my earnest money. Okay. The contracts are written for buyers. So there's lots of ways. You have a due diligence where you get to have an inspection and figure out if there's anything else wrong with the house, if you want to ask for any seller concessions, if you want to ask for any repairs. So you'll have that deadline that you can get your earnest money back. You'll have a finance and appraisal deadline if the appraisal comes in low, or if you want to negotiate anything with that. And so there's different ways that you can still get your earnest money back. Then you'll meet with your lender after it goes under contract, get quotes for home insurance, and start the loan process. You'll sign disclosures, we'll get the appraisal ordered, and we will move forward with that. Once, asking for documentations, things like a copy of your driver's license, verification of your employment, those kinds of things, updated pay stubs if it's been a little while since you gave those originally. Okay, so it really is something that if you have a good lender and a good real estate agent, they're going to walk you through this. And they're going to go over these things again once you go under contract, once you are getting ready for pre-approval. But it's nice to be able to kind of know what's coming. But again, if you have a good realtor and a good lender that are helping you and that you trust, they're going to make sure to walk you through everything and make sure you understand everything as the process goes along. Okay, so just a little bit more in depth on the pre-approval process. It really is fairly simple. And people get really nervous about the pre-approval process. For me, that's why I like to have a 15-minute conversation, because I have a little spreadsheet that I can plug in income and debt and see, okay, this is about what you qualify for. Do you want to move forward? Before you go through the process of getting your credit pulled and all those things, we can talk a little bit about how much do you qualify for and see where you're sitting so that you feel comfortable. Key things to be prepared for: go through your budget and decide what you can afford on a monthly basis. So I talked a little bit about this before. Make sure you talk about, either with your partner, your spouse, or if it's just you, think about, what can I comfortably afford? Am I going to be too strapped and you don't want to be house poor, right? We can qualify you up to 45% of your debt to income. So that's your gross income before taxes. So that's probably a little bit more than's comfortable if people go to their max, and people are doing that right now just to get into a house. And then they're hoping to refinance and be able to cut that payment down a little bit. But, you want to be comfortable and have thought about that. A lot of people will come to me and I'll say, okay, what kind of monthly payment do you want to stay under? And they're like, well, what can I afford? Okay, you want to think about what can you afford before you get to that point, because me telling you what you can afford is different than you telling me what you want to afford. I'm not going to look at utilities, phone payments, all those kinds of things. Those are going to be an addition, and they won't even go into the calculation. So you want to kind of be able to look. The only things that are going to go into that calculation are things that show up on credit. So car payments, monthly credit card payments, and those are all the minimums, remember? So just make sure that you are aware of what you can afford. And you could talk about that with me, sure, but it's a good idea to think about that before too. think about, well, if you're both going in for a house, well, one of you maybe stop working, maybe one of you wants to stay home with the kids. And so, in the future, how's your income going to look? And so think about that too. This is a 30-year loan. Minimum, maximum amount of money for a down payment and closing costs. Where's that coming from? Again, you want to think about, you've got, closing costs, maybe 10 to 12,000 is about an average on a $500,000 purchase price. So you've got that's in addition to your down payment that's required of 3%. So make sure that you know where that's coming from. Right now, a lot of my contracts are getting seller concessions, meaning the sellers are paying for some closing costs, temporary buy downs, permanent buy downs. And so right now, that's another thing I kind of say, houses are on sale in this type of market where sellers are willing to pay a little bit of the buyer's fees. That wasn't the case not very long ago. You need a 2-year work history. So when we say that, you don't have to be in the same job for 2 years, but you need to be have worked a job for 2 years. And one thing we talk about a little bit, and that's hard, is variable income. So variable income means that your pay stubs don't show the same hours every time. So let's say one pay stub you have, and you get paid every 2 weeks, one pay stub shows 80 hours, the next pay stub shows 76, the next pay stub shows 79. Now in your mind, you're like, I work full time. But if you don't have PTO and you're taking time off, then we're going to look at that as an average, and we're going to have to average over the last 2 years your income. So you're going to qualify for a little bit less income. So when you're looking to buy a house, make sure that you're working the full hours that you want to count, because let's say you just started a new job, and it's variable. You're going to have to be on the job for a year or have been on a variable job for a year to be able to count that income. So talking with a real, somebody even 6 months before you're ready to buy is going to be helpful, right? Especially if you're not on salary. If you're hourly, we want to show the same amount of hours every pay stub to be able to count the most income. Okay. Again, you don't have to be on the same job for 2 years. You can have switched jobs, but you want to limit the amount of time in between jobs. So on an FHA loan, if you have more than 6 months gap between jobs, you're going to have to be on your new job for 6 months before we can count that income. So limiting gaps between jobs is super important, and being consistent on jobs. If you just started a new job, we're going to have 2 pay stubs for an hourly worker before we can count that income. So kind of keep in mind, it's not that you can't change jobs right before you buy a house, but you just have to plan for that. So if you're thinking about that, contact your loan officer. Let me know, talk to me about it so that you can make the right decision beforehand instead of trying to play catch up after. For self-employed though, like if you work for yourself, have your own little business, or if you get paid 1099, meaning you don't have W-2 income, you're going to have to be on the job for 2 years before we can count that income, or you'd have to do a bank statement loan, which would be 1 year, 12 months of bank statements to show the income. Sometimes even when you file your taxes, you might want to look at a bank statement loan, because when you file your taxes, when you're self-employed, you're going to want to show the least amount of income. And when you're trying to get a loan, you want to show the most income. So bank statement loans are a little more expensive. Rates are a little bit higher, but they are doable. So 2 years of tax returns, 2 years for self-employed. So call me if you're self-employed. Let's talk about what the best thing to do is. But just reaching out and asking questions about work history and jobs is going to be helpful if you're trying to plan for buying a house. How long does someone need to be on a job or self-employed to get a loan? We talked about that. What if it's a new job? We talked about that. So just make sure that if you are hourly, you are working a consistent same hours every paycheck so that you can qualify for the most income. We talked a little bit about this. We'll go over this again one more time before we finish up. But again, first thing after you go under contract, you're going to send the contract to your title company and to your loan officer, and your realtor will do that for you. You're going to have earnest money amount, and you're going to want to give that to your loan office, or excuse me, to your realtor if they're going to hold it in their brokerage, or to the title company. And your realtor will let you know that. You'll actually have a form if it's being held at title that you'll have to sign with your contract. Now, locking in the rate right now, what I typically do is I will look at the rates and I will lock them in after I discussed with you your options, if you want to do a buy down or not, and we'll get that rate locked in. I like to lock in the rates immediately because I don't like the idea of rates going up and I don't like to gamble. So basically what I do is lock in the rate. If rates goes down significantly during your loan process, then we can do a free float down. So you're protected from rates going up, and then you're also protected from rates going down, because if they go down, you want to be able to utilize that. And if they go down at least a quarter point or more during the loan process, then we can do a free float down before closing. Comparing quotes is something people talk about a lot. You should get 2 or 3 quotes. And I'm not opposed to that at all. I typically, when I do business, I find somebody who's not the most expensive, not the cheapest, and I kind of go mid-range, but I also utilize people that I trust to give me a good recommendation. And so I always tell people, if you want to shop, that's fine. If you find somebody else who has a better, you feel like is a better loan estimate, send it to me, because I typically am very competitive and typically come in about $500 difference with anybody that I compete with. You'll see those billboards on the side of the road that show what seems like lower rates, then you're going to get quoted. And most of those on the billboard are quoting with a 2% discount, extra fees, and then also 40% down, which makes a difference in the rate. So when you're comparing quotes, look at the rate and look at the fees from the lender. Don't look at prepaids, property taxes, days of interest, homeowners insurance. Those are all estimates to begin with, and they're all just going to be what they're going to be. So you really don't compare with that. You want to look at the fees that they're charging for the rate. And then you also want to look at the number of days that they're locked in, because you might have a different rate on a 30-day lock versus a 60-day lock versus a 45-day lock. And so what I tell people is, I always want you to get the best rate. If you send me a quote from another lender, I will almost always be able to match it. And if I can't, I'll tell you, this is a really good rate, go lock it in. So I'm always going to do what's best for you, but I always love it when people let me compete and compare, because sometimes when you're looking at a loan estimate, it's really hard to compare apples to apples. And so you want to be able to have somebody who knows, look at that for you. I tell people not to shop an APR. You'll always see quotes. If somebody's quoting a rate, they have to quote an APR. And what that was designed for was to compare rates, but it hasn't turned out that way. And so I never talk APRs, because I feel like it's just a number that people can put down. And I don't feel like it's accurate all the time in comparing. But what the idea was, okay, you have this rate locked in, let's say it's 3%, and the APR is 4%. So with the fees, this is your, the cost of your loan. So ideally, if we could trust everybody to give an accurate count or calculate the APR the same way, then you could shop based on APR and know that what your effective rate is with the fees. But I don't feel like that's really happening. So I recommend not shopping on APR. So compare the reputation of the companies. I had one company that came in lower than me, but we looked online and they had all sorts of complaints. And so you don't want to, you really don't care what the fees are at the very last second if you're going to lose the house. So make sure you're working with somebody who's reputable, who's going to, if they say they can get a loan done, that they'll get it done for you. Yeah, when it comes down to the last minute and you're going to lose your earnest money, you want somebody to get that loan done. So make sure that you're dealing with somebody reputable. So you're going to have deadlines I talked about. You're going to have seller disclosure deadlines where they have to give you the disclosures on the house. What's wrong with the house? What do we know is wrong? Is there a leak in the roof that we know about? Is there, a crack in the foundation that we know about? They're supposed to send to you anything they know about that might cause problems. Due diligence, that's where you get an inspection, and you always want to get a home inspection. There were times when people were waiving their due diligence, and I don't recommend that. You want to get a home inspection and find out if there's anything wrong with the house that you can't see. Financing and appraisal deadline. If for some reason something comes up and you can't get your loan, you want to be able to get your earnest money back. So that's what that's for. And then so you have a financing deadline and you have an appraisal deadline. If the appraisal comes back lower than purchase price, you want to be able to negotiate. So you have that deadline too. So you won't lose your earnest money. And then settlement. So settlement is when you sign the documents. Closing is when it funds and records. So you'll sign your documents, and then you'll also have to fund, meaning the loan funds, all the funds go to title, they disperse them to the sellers, and everybody gets paid, and then they record with the county. Ordering appraisal and title work, that's the next step, and that's going to happen. Your loan officer is going to do that. So basically, this is like, we talk about it like going to the doctor, right? You're going to talk to somebody and they're going to work on everything for you. It's like when you're talking to the nurse, you get everything in, and then the doctor comes in and finishes things up and makes sure everything goes smoothly. Day of settlement, you'll go sign your papers. There's about 60 signatures, and then you wait for it to fund and record. Cash to close, if it's more than $10,000, then you're going to have to wire it. You can't just bring money to closing the title. You can't write a personal check. So we'll plan for that and keep you informed. Same with earnest money. You can't just bring cash to your realtor for earnest money. We have to prove where that money came from. And so you can't just bring that. Your down payment has to come from a reputable source too. You can't just bring cash for under your mattress and deposit it in the bank and then send it to closing. We have to know where that money came from, or it has to be in your account for 60 days before you can use it. Property taxes, homeowners insurance, and HOAs. If your property taxes will be paid by your mortgage, your homeowners insurance will be paid by your mortgage. HOAs will be paid by you. They'll count against you for the debt to income ratio, but the HOA will be paid by you. First payment. So mortgage is a little bit different than rent. For rent, you pay for the month coming up, right? You pay on the first of the month of August for August, that August rent. Mortgages are different. You're paying the previous month. So when you paid August payment, you're paying for July's interest. When you pay September's payment, you're paying for August interest. And so you pay, but they're just a little bit different that way. They'll be due on the first of the month. You'll have a 15-day grace period. After 15 days, you'll have a late fee. After 30 days, you get a late on your credit. And a late on credit means you can't get another mortgage for a full year after a late on credit mortgage late. So that's a big deal and something to remember. Okay, so we talked a little bit about credit. We talked about collateral. That's the home. If you don't make your payment, they can take your house. Capacity, your ability to pay, your debt to income ratio, and compliance. We have all these boxes we have to check to comply with the loan features to be able to get you a mortgage. Okay, I'm going to kind of stop there. I'm hoping to get some feedback from you. If you have any questions, let me know, because I can make another video and add some of those questions in if I'm continually getting questions. But hopefully this gives you a kind of a head start and opens up the doorway for communication between me and you as you are navigating this fun time and hopefully becoming a homeowner and creating your own wealth instead of continuing to be a renter and creating somebody else's wealth. Again, my name is Edyn Johnson. I'm with Security Home Mortgage in Lehi, Utah. Here's my information. Hope to hear from you soon. Have a great day.